Will be starting in approximately 6 minutes. So I'm going to I'll be muted until just a few minutes before we get started. Um, this will take approximately an hour and a half of time that we will be going through materials. And this information is being recorded, and the presentation will be sent to everybody as far as a PDF file. So just to answer those questions up front, um, there will be audio on my part. We will not open it up for any comments coming this way because with 200 or 300 people, it would we'd have pure chaos. So, but I will be on mute for just a couple more minutes. Again, good afternoon, everyone, or good morning, wherever you are located. We will be starting in approximately 4 minutes. And the screen you should be seeing is test preparation with the poor guy sweating. Um, this is a true depiction of the people that are taking the test. So just letting you know. Um, Hopefully my uh, audio is coming through okay. And there will be audio on my part, but no audio. Everybody will be muted from your side. With a couple, 300 people, we can't afford to have everybody jumping in or we'll be here for days. So uh, anyway, we'll be starting in approximately 3 minutes. Make sure your chats are answered, but we may not get to all of them. So. Okay, we will get started. Um, Welcome to Test Prep from MEC. Hopefully you will all be able to enjoy the presentation, pick up some ideas and some things that may help you in passing the ultimate or the infamous NMLS test. My name is Marv Stockert. I started in the mortgage business when I was 5. I've been in the business for over 50 years, so I've seen everything that you can imagine. So when people say that they're struggling and don't like to see interest rates over 3.5% to 4%, For those people that have been around a while, I was originating mortgages at 18% fixed, 12.5% one-year arms. And we were the heroes when we were doing one-year arm at 5%. I mean, at 12%. So enjoy the lower rates and enjoy the business while you can. Now through NMLS or MEC, there is test prep course and practice tests. And I'm offering also tutoring packages of one-on-one sessions. There will be 5 sessions meet a minimum, and we will work on getting materials and having you prepare. Now, one of the things I want everybody to understand, this is a federal test. There is no state tests any longer. No individual state has a MLO license test. Also, you will not be getting a national license. There is no such thing. It is only a state license that you must have in every state that you want to originate loans. But your company must be licensed there before you can apply for the license. Now, on the test, you should arrive 30 to 40 minutes early. Bring in a driver's license only. Calculators, paper and pencil, purse, billfold, cell phones, they will not be allowed. They may give you something to store them in, but you will not be able to bring them into the testing area. Now the calculator that is provided at the test will allow you to do plus, minus, divide, and times, so you will not be able to calculate mortgage payments or APR. So now you have 190 minutes for the test. There's 125 questions, of which 10 of those will be thrown out. So your ultimate goal is 75% of 115 questions, or 87 right. Now, here's a tip that I really finding that helps people prepare and once they're into the test. You open the question, read it twice, very slowly, because there are so many double and triple negatives, as well as scenario questions. And the one word at the end of the question may be indicating what your answer will be. I see people reading question and they answer it based on the first 7 or 8 words, and then the last word on the question is the one that would have given you the answer. Do not take any more than 30 seconds per question the first time through, because you've only got 190 minutes. There's 125 questions. If you start taking 2 minutes per question, you're going to run out of time. So 30 seconds per question. If you'll have to answer a question, then you can move on to the next question. If you aren't sure or don't know, then click on hold or review so that the question will be marked. Now, you'll go back up, open up the ones that you have marked as not sure of or don't know. Now, one of the key things is do not change an answer unless you know for a fact the answer is wrong. If you start second guessing yourself, you will change answers that you had right. I've had students who had 4 or 5 questions that they had changed, and they ended up with a 74. Because of the questions, they then analyzed when they got all done and realized that 3 of the answers that they changed were in fact right. So don't change unless you know for a fact that they're wrong. Now, I'm not trying to scare anybody, but I want you to all be aware that the pass rate right now is 54% for those people taking the test twice. It's 42% for people taking the test the second time. Again, don't study the same material that you had on the first test because they have over 1,000 questions that they're going to draw from. So the odds of you seeing the same question twice in a row on the two different dates for your test is probably slim and no way. So the thing to remember is take your time. Your breathing rate shouldn't be any greater than just above death, because if you start rushing, you're going to have an issue. Okay. Now, one of the big things on the law is fair lending, fair housing, and ECOA. Any person wanting to apply for a mortgage must be allowed to do so unless they're under 18, because you can't get a mortgage until you're 18 or above. The key thing is everybody has the right to apply, and you must use equal credit no matter who they are, what they are, doesn't make any difference. Everybody should be analyzed based on the credit criteria that you're using, for whether they're blue, green, purple, I don't care. It is all the same credit criteria. Now, the rules. Homeownership Protection Act, HOPA. It's under Truth in Lending and Reg Z. It covers predatory lending, abusive lending, which tells you if you are forcing people to take a program they don't want. You're not disclosing all of the terms of the loan. You're not giving them all the costs or not even issuing the LE. Negative amortization is not allowed on any loans except reverse mortgages. Now, prepayment penalties, again, are not allowed on any of the agency, what I call the big five: Fannie, Freddie, FHA, VA, and USDA. Prepayment penalties are not allowed. But if they were, they could only be charged the first 3 years and no more than 2% of the balance at the payoff. Now, balloon lending is allowed, but your balloon cannot be any less than 5 years, meaning you can amortize the loan and have it amortized on a 30-year loan, but at the end of the 60th month, the loan would be called due. Now, subprime lending is any loan or product that you are putting people into that could lead to delinquency or foreclosure. Now, equity stripping, or also called churning, is you are refinancing the same loan over and over with little or no benefit to the consumer. The only people benefiting is you, because you and your company are charging a fee on every time you refinance. Now, the ability to repay, a hot button in the industry today. That ability to repay says, based on what you know at the application, would that borrower be able to make the payments in the future? Now, we know death, divorces, and medical you can't anticipate those, but based on what you know. Also, a true good item to follow is this. If you were using your money to make a loan, would you make this loan? If you wouldn't, why are you putting your company in that position where they may have to repurchase the loan? So that is something that you've got to be, I think, conscious of. Now, as a part of HOPA, we've got the calculation for high cost and high priced. The key thing here is remembering APOR, which is the average prime offered rate. Now, don't confuse this with ARM indexes, because this is not an ARM index. This is just an index that is used to calculate high cost and high priced. So high cost lending, there's three triggers: 6.5% on a first mortgage, 8.5% on a second, and 5% for a fee trigger. That says 5% of the loan amount, and that's including on a brokered loan, the yield spread premium that's being paid from the wholesale lender to the broker. If you go over 5%, then you've got a high price loan, or high cost, I'm sorry. Now, if let's say on our example today that our APOR index is 4%, that's just for today. You would take that 4% APOR trigger or index, add it to 6.5% on first mortgages. That comes to 10.5%. If your annual percentage rate, APR, is higher than 10.5%, again, you have a high cost loan. Now, what it requires is this. You got to have mortgage insurance on any loan over 80%. Escrows are required for taxes and insurance. Counseling is mandatory, and a full appraisal is required. You will not be able to use an appraisal waiver. There has to be an inside and full exterior appraisal done. Okay. Now, that is high cost. Section 32. Section 32 is high cost. Now we go to high priced, which is section 35. Now the triggers are significantly lower. 1.5% on a first, 2.5% on a jumbo, and 3.5% on a second. Now there isn't a fee trigger like there was on high cost. Again, mandatory mortgage insurance over 80%. There's mandatory escrows for the first 5 years, and a full appraisal is required. There's no counseling required. Now, example is if our index, if you remember, was 4%, the trigger is 1.5% on a first mortgage. That says that's 5.5% APOR index and the 1.5% trigger. Your annual percentage rate cannot exceed 5.5%. All right. Now, Equal Credit Opportunity Act, ECOA or Reg B. If you see any one of these three titles, it's all the same law. Now, there's 5 parts to ECOA. Number 1, age, you got to be 18 years older and to get a mortgage. Discrimination, you cannot use any of these items to make or decline a loan, male or female. Marital status is married, unmarried, or separated. That's all you can ask. Now, race and color, come on, folks. We don't have any place in the country, but especially, come on, not in the mortgage business. We have no reason to be discriminating on any loan. Now, age in this case is, I don't care if a borrower's 20, 40, 60, 80, or 100. If the borrower qualifies, you make the loan. If the borrower doesn't qualify, well, they don't get the loan. It's very simple. Now, you don't ask about religion or national origin. Now, public assistance, it's a tricky one. If a person walks into the office and says, I want to apply for a loan, a couple questions in, you find out that they're on public assistance. You can't tell the borrower, come on, get out of here. I don't have time for you today. You have to take enough information to be able to determine if that loan should be made or not. Now, we know that on public assistance, it's usually only for 1 year. So you couldn't count it anyway because you need at least 2 years worth of potential income going forward. Now, once you have a complete underwriting package, all the verifications, all of the appraisal, all of credit and everything, now the underwriter has to make a credit decision within 30 days. If the underwriter says, no, I need some additional documentation, well, then the loan is suspended. You can go out to 60 days. If the underwriter says, I want to offer a counter offer because I can't do a 15-year loan, sir or ma'am, but I could do a 30. Well, because it's a counter offer, it goes out to 90 days. So 30 immediate, 60 suspended, 90 on a counter offer. Now, the appraisal must be delivered to the borrower no less than 3 business days before closing, but should be delivered upon receipt from the appraiser. Now, adverse action from 30 days or within 30 days from a loan being rejected, canceled, or withdrawn by the borrower, an adverse action must be sent to the borrower telling them why. Now, here's a hint. If you can remember 6 words, I would recommend to you that you should look at Equal Credit Opportunity Act first. I'm not going to say it's that way all the time, but at least I would look. So age, discrimination, underwriting, appraisal, and adverse action. Again, I'd look at ECOA, not always going to say that's going to be the answer. Okay, now Fair Housing Act, which was amended by ECOA. So the discriminatory items are very similar to ECOA, except for 3 items. Disability, can never refuse that. Also, familial status. If you have a lady, a woman sitting in front of you who is 7, 8, 9 months pregnant, you can't say to her, well, because you are going to be going on maternity leave, we're not going to be able to count your income. No, no, you can't do that. That is considered discriminatory. Now, age, unlike ECOA, age is exempt for 3 reasons. You got to be 62 to get a reverse. You got to be 55 to get into a 55 and older subdivision. Also, you have to be 18 to get a mortgage. So again, a small hint. If you see the word age in a discriminatory question, I would look at ECOA first. If the word age isn't in the question, then I'd look at fair housing because it is exempt. Now, fair credit reporting. There's going to be you have to order a tri-merge credit report on every borrower, but it is for underwriting only. It is not to be given to the borrower. It is for underwriting only. If you give it to the borrower, you're saying everything is right on it. How do you know that? You didn't prepare it. So there's a risk-based disclosure that explains, dependent on your credit and the risk on not loan, there might be pricing adjustments. Now, credit score disclosures. You always, when you're declining the loan because the borrower was declined because of credit, you have to issue an adverse action. You use the middle of the two, or the lowest of the 2 middle credit scores. So if the borrower's got a credit score of 800, the co-borrower's got a credit score of 600, you would use the 600 score on the disclosure. Now there's 3 agencies, Experian, Equifax, and TransUnion. Whenever there is an error, the borrower can go to all 3 of these and state that what the error is. Those 3 agencies have to remove the errors or anything that you have on dispute within 30 days. If the credit agencies find, yes, there is an error or a dispute. Now, FACT Act, oh, come on. That amended Fair Credit Reporting Act. Now, one of the big things here is every person, every consumer in the United States has the right to get 1 free credit report every year. Every year. They can get more, but they have to have the right to get at least 1. Now, that is the best place to get that is annualcreditreport.com. Now, also, it gives the consumers the right to file a fraud alert 90 days after they've had somebody stole their credit card or hacked into their numbers. Also, they can freeze their credit. Now, when the credit is frozen, of course, you can't pull it because there isn't any credit that will be shown. So they will have to unfreeze their credit for you to be able to freeze credit. To pull credit. Now, this isn't a mandatory thing about the law or anything else, but it should be recommended to them not to refreeze their credit until after the closing. Why? Most, if not all mortgage companies pull another credit report at closing to make sure there isn't any dramatic changes in the credit. Well, if they've refrozen their credit, that may delay because now they have to unfreeze again. Now, the other part is truncation. When on your credit card, debit card, or bank deposit receipts, only the last 5 digits can be shown. Today, most of it is only 4. Now, red flags, which is enforced by the Federal Trade Commission, if you call in and want to change your contact information, they can't change it until the company either emails you, texts you, whatever you have set up on your account, asking you, did you request to make these changes? Now, also, the employees are to be trained on how to identify a breach of security. Computer stolen. Somebody hacked into the server. They are to alert the compliance officer or senior management, and within 30 days of that alert, the company has to send a letter to everybody in the database telling them, we've had a security breach and here's what we've done to protect you, and here's what you should do to protect yourself. Now, the Graham-Leach-Bliley, or GLB, whenever you see this, Reg P is appropriate because it's privacy, privacy, privacy. Companies have to inform you, and you get a notice every year. Most people throw them away. They tell you what they do with your NPPI, non-public personal information. Do they share it, sell it, give it away, whatever? You have 30 days from that notice to opt out, telling them, no, 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 I don't want my information shared or sold or whatever that can be done. Now, phishing or pretexting, and I'm sure we've all seen this. You get a text saying, we're from the IRS. We're having problems with your social security number. Please verify the one that's listed here. If it's not correct, please send us the correct one. Well, you know what's going to happen if you send them the social security number, you just have lost your identification, or you're going to lose your history because somebody's going to hack into it. Now, safeguard rules, also overseen by Federal Trade Commission. All files, when you are using them, can be on your desk. But any other time when you're not using those files, they are to be locked up in a drawer or filing cabinet. Now, in today's world, a lot or most of the files are on your computer. Now, you got to have a lockout so that people can't get into your computer to steal the data. Now, all files must be kept for 3 years and 5 years for the closing disclosure. Now, HMDA, Home Mortgage Disclosure Act, or Reg C. Now, the way to remember Reg C is HMDA requires you to collect data on every loan. So HMDA requires collection. Oh, that means Reg C. Or Reg C means collection of data. That's HMDA. Now, the companies must file annually by March 1st. And I'm talking over 40 fields that have to be collected. Now, mortgage brokers are exempt. Why? Because they don't underwrite or fund loans. So wholesale lenders, mortgage bankers, banks, and credit unions are required to file these annual reports. Now, this is an extremely important item. There are 6 items that if you have these 6 items under the acronym PENCIL, an LE has to be issued, except If the loan is withdrawn or the loan is canceled, declined, within that 3 business days of the initial disclosures. But anything other than that, you have to uh, issue an LE. P for property address, E for estimate of value, N for name, C for credit or social security number, I for income, and L for loan amount. So those are the 6 items that tells you you have items that need, or you'll now have to give an LE. Now, Federal Trade Commission regulates 5 regulations: MAP or Mortgage Acts and Practices, UDAAP, red flags, which we've already covered, safeguard rules, and do not call. All 5 of those, if you see those, that's enforced and regulated by the Federal Trade Commission. Now, do not call. Fines up to $40,000 per violation per day. Now, be careful. People say, well, it's 16,000. Yes, that's what it started out to. It is now up to $40,000. Now, you can pull data from the do not call database, but you can't use it if it's over 30 to 31 days old. If it's over that, you have to repull it. Now, there are 2 exemptions. You can call someone 18 months on an existing business relationship. Loan declined, canceled, closed, whatever. Or you can call them for 90 days on a pre-qual. Now, if you call those people within that 90 days or 18 months, you have to document who, what, and why you called them. And it must be kept for 2 years, all of the documentation. Now, if that customer sends you or your company a letter saying, no, I don't want any more solicitation, no programs, no nothing about, no marketing. Once that company receives that, that becomes an internal do not call. And that overrides the 18 months and the 90 days. So at that point, everything stops. You can't contact that customer. Now, one more thing under do not call. You can call soliciting between 8 in the morning and 9 at night. That's dependent on where the consumer is located. So if you're in New York and you're calling a consumer in California, technically you could call them at 11 o'clock, 11:30 at night. Now, there's 8 parts under Truth in Lending. Number 1, MDIA, advertising, HOPA, the loan estimate, the annual percentage rate, qualified mortgage, loan officer compensation, and charms booklet. Those are the 8 items that are covered under the base core of Truth in Lending and Reg Z. Now, MDIA is the 373. 3 days from application, completed application, or signed, the initial disclosures have to be delivered. The 7 is when the borrower brings in the signed intent to proceed, they could technically close 7 business days later. Not likely in today's world, but technically they could. Now, the CD has to be delivered no less and received by the borrower no less than 3 business days before closing. Now, once they get that CD, if any one of the following 3 things happens, a new CD has to be issued and a 3 business day delay. Number 1, a loan program changed. Borrower says, no, I don't want a 15, I want a 30. A prepayment penalty is added, or the APR tolerances are exceeded. Now, the APR tolerances on a fixed rate is 1/8%. On an ARM, it's 1/4%. So if your APR exceeds that, you have to issue either an LE or CD wherever the loan is in the process. Now, truth in lending under advertising. You have to have all of the information about your company, name, NMLS number, contact information. You also have to have the equal housing logo, which is the little house. And you have to have an APR if there is a trigger term or a number is what a trigger term is on the advertising, mortgage amount, interest rate. And all advertising has to be kept for 2 years. Now, HOPA, we've already covered under HOPA, which is high cost and high priced. Now, the loan estimate is under truth in lending. And that LE must be delivered 3 business days from the signed or completed application with all costs, fees, and terms of the loan. Now, the best or easiest definition of APR, it includes all of the cost from the closing and any cost throughout the life of the loan. Those all together compared to the amount borrowed, quoted as a rate. Not interest rate, but a rate. People say, well, you're telling me my interest rate's 3.875 and now you're telling me it's 4.217. No, I'm not saying that. I'm saying the interest rate is 3.875 and that's what you're going to be paying. The cost of the loan with all of the costs, that's what it's costing you over the life. Now, a qualified mortgage, there's 2 ways that you and your company can get safe harbor where you cannot be sued by the borrower because you prove the ability to repay. Option 1, 43% maximum debt to income or DTI. No more than 3% in fees. Again, remember, that's including the yield spread premium paid from the wholesale lender to the broker. Now, option 2 is you run the loan through Fannie or Freddie's automated underwriting system, and they meet high price mortgage lending limits or standards. Now you have either option 1 or option 2, you have a qualified mortgage. If you close a loan that doesn't meet these 2, you could end up having a cost to you of over $40,000 to $50,000 with all of the penalties and everything. So I recommend you never close one. Now, loan officer compensation. Simple, simple, simple. You can either be paid salary or commissions. On the commissions, it can only be based on the loan amount. End of statement, exclamation point. Only on the loan amount, none of the terms of the loan. Now, could you be paid a staggered bonus? Sure. If they say, well, for the first $3 million worth of loans, we'll pay you 80 basis points, which is 0.080 times the loan amount. Then for the next up to 5 million, we'll pay you 90 basis points. Over 5 million, we'll pay you 100 basis points. No problem. That's legal. But you cannot be paid a different commission level based on the type of the loan. So matter if it's an FHA, VA, USDA, or conventional, if you're a 100 basis point loan officer, that's what you're going to be paid on all of the loans. Now, the CHARMS booklet, which is the booklet, must be given to every borrower that's doing an ARM loan, and it's on purchases and refinances. Now, Reg N, which is MAP, Mortgage Acts and Practices. If you don't have it, don't advertise it. You can't use any bait and switch. Advertising, you got 2% fixed rate. And then people call in and you say, well, that was last week's rate. Our rate this week is 2 3/4. That's baiting and switching. Also, you cannot use any terms that would mislead the borrower in any way that they are not getting any of the terms that you have advertised. Now, Consumer Financial Protection Bureau, they enforce, they're the top dog in the heap. They can write, implement, investigate, enforce, prosecute, and fine any companies that are violating or putting people at risk. HOPA is definitely under CFPB, but just about every law we're going to be talking about is under CFPB. Oh, now digital delivery. You got to have ID. It doesn't include faxing or email. It's either DocuSign or e-sign. With identification, they have to have a signed agreement that also includes the right that borrower could go back to hard copy if they wish. Now, you also have to, at your best ability, to find out if they even have the technical skills to do digital. If they ask you, how do you turn on a computer, or they're sitting there with a Dell 286, probably not. That's not a person that you should be using digital. Now, RESPA is the loan toolkit, which is the booklet that explains what's going on the loan. On all purchases, this booklet has to be given. Now, the closing disclosure must be given to the borrower, and it depends on the company. On a purchase, there could be one for the seller and one for the borrower. Other lenders could say, we're going to have it all on one. That's as legal as having it two separate. But that borrower's copy cannot be given to anyone unless authorized by the borrower. Now, the final CD cannot exceed the final LE by more than 10%, except the no tolerance items. The no tolerance items are you have no liability on those. Now, big thing in RESPA is Section 8. It says you cannot pay or receive anything of value for referrals or kickbacks. And if there are referrals or kickbacks, all parties could be fined or prosecuted. Now that's a builder, a realtor, whomever. Now on that also, if you're doing joint advertising, that means you and the realtor or you and the builder, that can't be any more than 50-50 in cost. If it's more than that, either way, you better have it well documented why you or the realtor are paying more. Also, an affiliated business disclosure has to be given to the borrower upon disclosure of a conflict of interest or no later than 3 business days later. The MLO is also licensed as a realtor. The MLO or their family own as little as 1% of a third-party company, title, credit, appraisal company. In either case, an affiliated business disclosure must be given to the borrower explaining that there could be a conflict and that you could be being paid both sides of the transaction. Now, HPA, Homeowners Protection Act, covers conventional mortgage insurance. Now remember, conventional mortgage insurance is called PMI. FHA mortgage insurance is called MIP, mortgage insurance premium. Now, any loans above 80% requires MI. Once the loan gets down to amortized 80% loan to value, the borrower can request that it be dropped. But it's up to the lender. If the lender says, no, you've been missing payments, they don't have to drop it. But if the loan reaches 78%, now it has to be dropped by the lender. Now, the Bank Secrecy Act covers mortgage bankers, mortgage brokers, banks, and credit unions, anybody originating mortgages. It says everybody must be trained annually to identify fraud or money laundering. And what do? Well, if it's detected, that's the key word. You don't have to prove it. That's up to when the file is turned over to the compliance officer or senior management, they determine if it is actual fraud or money laundering, and if it is, a suspicious activity report is to be filed explaining what the reasons are. Now, whether the file is filed as a SARS or not, that information has to be kept for 5 years in a separate filing area and kept confidential. Now, the U.S. Patriot Act says all borrowers and donators of a gift have to be run through OFAC to see if anybody is on the federal watch list, which is terrorism and money laundering. And if they are, you got to contact OFAC to find out what they want to do. Now, a lot of companies today have that check done on the credit report. If it is, well, you don't have to go to OFAC. Now, here's some scary stuff. On the SAFE Act, which is your licensing law, both the state and CFPB, if after investigation they find violations, they could fine you up to $25,000 per violation. Now, red flags violations are $3,500, but if the FTC jumps in, it's an additional $2,500. Now, if you violate Section 8 of RESPA on kickbacks, referral fees, and any unearned fees, you could be up to $10,000 and wearing a jumpsuit, orange jumpsuit, for up to a year. Now, the Dodd-Frank, they put some additional penalties on. The first tier is if you're issuing a memo saying we aren't going to do loans less than 25 years of age. That is a resulting of a civil penalty up to $5,000. If you are recklessly engaging in consumer law, that's up to $25,000. If you are doing everything deliberate, reckless, manipulation, deceit, or fraud, you could up to $1 million or $1,087,450. So these are important. Okay. Now, whenever you see a question about type of properties or what is going to be on residential, 1 to 4 family only, never answer the question any residential. That's wrong. I can have a 5, 6, 7, 8 unit apartment building. That's residential, but that's not covered under our laws. That's commercial. So 1 to 4 family is the only thing that you can have. Gifts must be a blood relative or the company. The big thing is no evidence of repayment. So they can't have a statement on there that says, upon the sale of this house, this gift is to be returned. Well, then it's not a gift any longer. That's a loan. Now, loan to value on a purchase. This is key. Purchase price or appraised value, whichever is less. That's divided into the loan amount, and that gives you your loan to value. Debt to income. Gross income divided into your gross debt, mortgage and monthly debt, gives you your debt to income or DTI. Now, loan to value is the value of the property divided into the first mortgage balance. That gives you your loan to value on a refinance. Combined loan to value is the value divided into the first mortgage plus the amount that you've drawn from the HELOC. So if I got a $100,000 HELOC and I've drawn 50, then I would take 50 and add it to the first mortgage divided by the value. Total loan to value, you take the first mortgage plus the whole HELOC or second mortgage and divide it again. That gives you your total loan to value. Now, if it is a second mortgage, the combined loan to value and the total loan to value are going to be the same because all of the proceeds have been dispersed at closing. Now, PITI is principal, interest, taxes, and insurances. Okay, now conventional conforming, only those loans that can be sold to Fannie or Freddie. The maximum loan to value is 97%. Any loan above 80% must have MI and escrows. Now, the ratios that you are going to use for the test, they aren't being used in a day-to-day situation, but for the test, it's 28% for housing, 36 for overall, which is including the debt and the mortgage. You can't have loan term or loan over 30-year amortization. Again, no prepayment penalty or assumptions. And for those that don't know what an assumption is, the seller sells their house, the borrower wants to come in and take over their mortgage. They can't do that under conventional loans. Now, non-owner occupied is allowed. Of course, there's going to be greater down payment and pricing differences accordingly. Now, non-conforming, simple. Any loan that can't be sold to Fannie or Freddie, non-conforming. Jumbo or any loans that are using non-verified income, any loans that don't meet Fannie or Freddie. Also, any loan that's over 30-year amortized loan. Now, non-traditional. This is where people get tripped up. It is any loan that is not a 30-year fixed. So if you have a question that says, what loan is not a non-traditional loan? Well, the answer is a 30-year fixed. But they'll, again, because of the double negatives, people get tripped up in what they're asking. Now, USDA, in areas of less than 35,000 people, and there's some income limitations, meaning every person in the house, grandma's there with Social Security, kids are still living at home, any income. If it's above the average income or median income for that area, they won't qualify for a USDA. It's 100% financing. The ratios are 29:41. The MIP is 1% upfront and 0.35 at renewal. Now, the unique thing about USDA, they have to underwrite and fund all loans, which is unique because every other program that's going to be done, the lender has to fund the loan. But USDA has to fund it. Where that comes a problem in the month of October, because that's coming to the end of the fiscal year budget, they may run out of money. Now, FHA, or Federal Housing Administration, which insures loans, they don't guarantee them, they insure the loan that if the borrower goes into default, the lender forecloses, submits a claim, FHA pays the claim, FHA gets the house. Maximum loan to value is 96.5%. The ratios are 31:43. Now, the MIP, or mortgage insurance premium, is required for the life of the loan if over 90% loan to value. The upfront fee is 1.75%. The seller concessions are limited to 6% of the mortgage balance. Now, veterans or a VA loan, if they have the DD 214, which tells you they have benefits, you run that through the VA website, and the VA will issue a certificate of entitlement or eligibility. That will tell you how much in benefits they actually have. If they have 100%, good, you got a 100% loan. The lower the benefits, the more down payment they're going to have to make. Now, I don't know, I doubt if this would be on the test because it's fairly new, but the VA just announced that the loan limits on VA loans is unlimited. So they want to buy a $2 million house and they have full benefits, they can get a $2 million loan. Now the overall ratio is 41%. They also have a residual income calculation. They take the number of people in the house times the VA factor, which is different in different parts of the country, plus the mortgage payment and any other debts, can't exceed the net income. VA loans have the lowest delinquency rate because they use the net income and not the gross. Now, adjustable rate mortgages. People really struggle with these. If the program is a 5-1 ARM, that says the rate is 5 years, the same, and then it adjusts every year after the 5th year. We're going to say the caps are 2 and 5. That means on each adjustment, the interest rate can't go any greater than 2% of what they're presently paying. No more than 2% below what they're presently paying. Now, the second number is the life cap. Let's say the starting interest rate is 4% and the life cap is 5. Those two numbers added together gives you a 9% life cap, meaning the interest rate can never ever go above 9%. Now the margin is the only item that can't change, and it is also the floor, meaning the interest rate can never ever go below the margin. Now there's index, which is the item that changes hourly, daily, whatever. The most common index today is London Interbank Offered Rate. Now that's going to be eliminated in 2021. The new index is called SOFR, S-O-F-R. Now, there's 2 other indexes that are also used. COFI, C-O-F-I, Cost of Funds Index. That's going away next year. And the Treasury Index, which is extremely volatile. Now, the key term you always want to remember, fully indexed rate. You add the index and the margin. Index and the margin, that's the only 2 items. If anybody says fully indexed rate, index and the margin. Now, reverse mortgages. Well, neg am, payments, the principal is going to go up every month. Why? Because there's no payments. No mortgage payments being made. Also, the amount that the borrower is being paid, that's also being added to the principal. There are no escrows, so the borrower is responsible for making sure they pay their taxes and insurance. The minimum age, got to be 62. Any owner of the property that is under 62 can't be on the loan. So they become a non-borrowing occupant. There's mandatory counseling before you can even apply for the loan. Now, this is a real benefit on the non-recourse mortgage. If the balance at the end of the loan is higher than the value, the FHA absorbs the loss. Now, at each year, they're going to be required to certify three things. Taxes and insurance have been paid. It's been their primary residence. And they have to maintain the property. Now, second liens. There could be what is a purchase money second or a piggyback. Now, on a seller carried back, they're taking part of the down payment and putting it as a second mortgage against the property, which the borrower is going to have to use in qualifying for the loan. Now, the other one is called a piggyback, where they're doing a first and second right at the same time. Now, most of the time, that is being done to eliminate mortgage insurance. So you're going to see terms like 80-15-5, 80-10-10, meaning 80% first mortgage, then I don't need MI. 15% second, and I got to come up with 5% of the loan amount in verified assets. Again, that second mortgage has to be calculated in the payments. Now, home equity line of credit or HELOCs. Mortgage brokers can't do them unless they're referred out to a partner. Most mortgage bankers won't because it ties up too much money. It is called, along with a reverse mortgage, an open-end mortgage, which means the balance can go up and down. A first mortgage and a second mortgage are called a closed-end mortgage, meaning the balance is at the highest at the beginning of the loan and continues to go down and no money can be advanced. Now, all home equity line of credits require a right of rescission, which gives the borrower 3 business days to cancel the transaction. Now, the term is usually 8 to 10 years. The interest rate is floating. Now, on the HELOC, once it's determined how much they can get, they pay no interest on that money until they use it. So every month, if they haven't used any of it, they pay no interest. If they draw money, they don't have to make principal payments unless they want to. But the borrower must pay interest on whatever their balance is throughout the month. And at the end of the month, they'll get a statement that says, you owe us this amount in interest. Now, a second mortgage, very simple. All of the money's paid out at closing. They'll start mortgage monthly P&I payments within 45 days. The term is generally 15 years, and it could be an ARM or a fixed rate mortgage. Now, subordination agreement, very simple. If I've got a first mortgage over at Company A and I got a second mortgage over at Company B, before I can refinance just my first mortgage, I have to go to my second mortgage lender or the HELOC lender and say, I need permission from you so I can refinance my first. That's a subordination agreement, which says, I'm going to stay in the second position while you refinance your first. If they won't give you that agreement, then you can't refinance just your first mortgage. Now, mechanics. Remember, the application is the 1003, but it also could be referred to as Freddie Mac 65. The Fannie Mae is the 1003, Freddie Mac is 65, also called a Uniform Residential Loan Application. Just for your information, the present application is 4 pages. There's a new one coming out that's effective this year. Could be 10 to 15 pages. How about that? That's one of the government reduction in paper programs. So now, any liquid assets that you need to verify could be checking, savings, money market, could be a gift letter, could be a withdrawal from a 401k. That has to be verified, showing that you have enough, or the borrower has enough money for the down payment and closing costs. Now, there's reserves required on every loan. 2 months reserves for owner occupieds. 2 to 4 units, it's 6 months. Now, the reserves do not have to be taken out. The underwriter just has to be able to see that that's in your 401k or retirement accounts. Now, how do you verify assets? Well, you got 2 months bank statements or investment statements, as well as a verification of deposit. Now, all income for any loan must be verified with at least 2 months W-2s, 1099s, the most recent pay stub, and 2 years tax returns with a 4506 T as in Tom. Now that's sent to the IRS. They come back with a certification showing what their tax return shows. Well, if yours don't match up with what IRS says, you probably have fraud. Self-employed, you got to have a 2-year history plus 2 years personal returns. And if the borrower owns 25% of the company, you need 2 years company tax returns and a year-to-date operating statement. Now, on these 5 items here, listed under number 5, self-employed, overtime, bonuses, commissions, and capital gains, you have to have a 2-year history before you can use it. And also you have to be able to see that that income is going to continue for at least 2 to 3 years. Now, these are just some of the disclosures. Loan estimate, intent to proceed, the loan toolkit, the CHARMS booklet, preferred providers list, which is provided by your company, listing the companies that are going to provide third party. Now, keep in mind that third party list has to have one company for each third party provider, and you cannot require a borrower to use any of those. That's up to them. Affiliated business arrangement, if there's a conflict. Homeownership counseling. On any loan that is high cost, it must be delivered within 3 business days and requires 10 counselors within 10 miles of where the borrower presently lives. Now, change circumstance, anything changing on the loan, terms, rates, APRs, locking the loan, anything, you have to issue a new LE within 3 business days of the change. Now, the final LE, this is a weird number. Everything in the mortgage business is 3 or 7 days. This is 4. So your final LE has to be received by the borrower no less than 4 business days before closing. The initial CD must be received by the borrower at least 3 business days before closing. Now, the confusing thing on consummation, that's when the borrower is legally obligated. That can only happen when the loan has been dispersed. I'm not obligated just because I signed the papers. It's when the money has been dispersed, now I'm obligated. Now, credit, you got high, low, and middle credit scores. You always use the middle for underwriting. Now, these are just some of the items that are used for FICO to determine it. Payment history, 35%. Now, credit utilization says, how much credit do you have? How much are you using? The less you're using, the better your credit score is going to be. Credit history, how long have you been using your credit accounts? That includes if you're getting credit cards, opening them and then closing them right away, or closing any credit cards could affect your credit score. Then the credit mix, how much of it, different cars, credit cards, whatever. And then how much new credit have you taken on recently? Now, title insurance, purely simple. The title insurance company is required to make sure there are no liens, flaws, encumbrances against the property prior to funding. Now, if it happens, if there's an error found after the funding, the title insurance company still has to pay it. The seller is required to pay for the seller's and owner's policy. The owner has to pay for the lender's policy. Now, the selling or the closing agent they're busy. They got to make sure that all of the items match up with what your mortgage company says or the lender. They have to explain all of the documents. They have to prepare the final CD. Now, any mortgage is a voluntary lien against the property with the house as collateral. And the first lien against the property is whichever mortgage is filed first at the recorder's office. Now, IRS tax liens, people think, well, if I got a payment program, I don't have to pay it off. That's not true. IRS says, I want my money. If you're refinancing or selling your house, I want my money. So it's got to be paid off. On a refinance, everything has to be paid in full so that your first mortgage is in first position. Now, very simple on the business day. Closing disclosures and right of rescission. Any day, including Saturday. On any other disclosures, any others, Saturdays only if the business is actually open to the general public. Okay. Now, ability to repay, again, we talked about it at the beginning. Would you be able to defend yourself in court if the borrower sues? Or if it was your money, would you make the loan? Now, occupancy, Primary residence is the only loan that requires a right of rescission. Purchases, second homes, and non-owner occupied do not require a right of rescission. Appraisals, you need 3 comparables on markets approach. Similar property, they have to have been sold in the last 6 months, and they're no more than a mile away from your subject property. The important one to remember is the adjustments, up and down because of room size, square footage, whatever. Those net adjustments can't be any more than 15% of what the comp sold for. Now, the appraisal can come back 2 ways. As is, good to go, close. With repairs, of course, there's got to be repairs. Now, who's paying? If the borrower is paying for the final inspection, then a new LE would have to be issued. Homeowner's policy, no less than the mortgage, but no more than the value. Flood insurance, Zone A and V mandatory, must be carried for the life of the loan. And that's any part of the house. PMI is always required on any loans over 80%. Now, calculating income, hourly. By the way, folks, I'm going to remind you, I'm running a little longer here, but you want to stick around because Anthony is going to be announcing a great program for you, so you want to be here at the end to hear this. So we've got a few more minutes, and then I'll turn it over to him. So hourly is number of hours times the hourly wage times 52 divided by 12. Now, overtime with 2 years history, you take the hourly wage times 150% times the number of hours divided by 12. Monthly income for your overtime. Again, 2-year history. If you're paid every other Friday, you take the amount paid for 1 times 26. There's always 2 extra pay periods if you're paid every other Friday. Now, on the 15th and 30th, 2 ways. You can take the amount paid on the 15th times 24 divided by 12. Make it simple. Add the 15th and the 30th, you got the same answer. Now, bonuses with 2-year history. If they're going down, you have to use the low amount. If they're going up, you have to average the last 2 years. Now, Social Security, it depends on how it was taxed. If it's taxed before I get it, then you can take whatever I'm receiving for Social Security and add 25% to it. So if I'm getting 1,000, I can use $1,250 to qualify. Now, interest calculation, very simple. Principal balance times the interest rate or note rate, nothing else. Note rate or interest rate divided by 12. That's how much the borrower is going to be paying each month. Now, per diem interest is your interest per day. You take the principal balance times the interest rate divided by 360 days on a conventional loan, 365 on a government. Government's got to be different. Then you take that amount, which is the daily interest, times the number of days from the funding till the end of the month, and that's called prepaid interest. Now, monthly payments, you can't calculate this on the test because your calculator won't allow it. But the three things that you will always need to or get a mortgage payment is the mortgage balance, the interest rate, and the term. FHA, 1.75% upfront. Conventional MI, based on your loan to value. Homeowners and flood insurance, you have to make sure that is always renewed every year, and you have to have a fully paid up policy at closing. Now, condo and POA fees may be required. It depends on the lender and depending on the association. Now, ethics, the biggest thing here, going to make it simple. You're working for the consumer or your borrower, but you have to protect your company. And redlining is you're saying, I'm not going to borrow in that area for whatever reason. Reverse redlining says, oh, I'm going into that area because I'm going to charge more for interest rate and costs, which again is illegal. Now, steering, you can't say to a borrower, Mr. Rodriguez, I think you should move into Hispanic Village. No, you can't do that. Come on. You can't steer a borrower into where you think they should. All referrals and kickbacks, you can't pay. Okay. Now, big thing, you cannot talk or contact to the appraiser on any reason. No reason at all. You can't ever contact. You can contact the appraisal company or the appraisal management company, but never the appraiser. Okay. One of the things on the power of attorney, which is one of the major scams or frauds, people just aren't looking at the power of attorneys, and that's got to be approved by the underwriter of your company. Now, one of the biggest things that the CFPB says, the biggest complaints from the borrower is you are not being professional and responding to the consumers or answering their complaints. Okay. Co-borrowers, co-signers, and borrowers are all responsible on the loan if they're required to sign the mortgage. Never assume the borrower knows anything, because if you do, you're going to get burned. Now, you do not tell a borrower when to lock or not lock. I did it once. I lost a lot of money. Your responsibility is to say, I really can't tell you. It's got to be your decision as to what you want to do as far as protecting your interest rate. Now, SAFE Act. Everybody has to be registered no matter who you work for, banks, credit unions, whomever. You as a mortgage broker or a mortgage banker, MLO, you have to be licensed. Now, keep in mind, mortgage broker is a company. An MLO is licensed to work for a mortgage broker or a mortgage banker. A mortgage broker isn't an individual. That's an MLO. Now, the NMLS, the big thing here is catch the first two words, nationwide multi-state. That is what is the areas that are covering, or they're making a mistake on it. Now, NMLS is managed by CSBS, bank supervisors, and ARMOR, which are state regulators. Now, again, CSBS, ARMOR, NMLS, HUD, none of those people can issue licenses. It is only the state that you are going to be originating each year. Now, every loan officer has to complete 8 hours of CE and pay their renewal fees by December 31st. If they don't, their license lapses. You've got 60 days to pay their fees or take a course called LATE, LATE, which will complete the requirement for the previous year. Now, if you don't do it by March 1st, now your license is suspended. The state will have to decide what they want you to do. Okay. Any commercial non-owner, they're exempt, not required. Non-financial, you can apply after 7 years from your conviction date. Financial felonies, you're banned. You're banned for life. As well, if you've had a revocation of any type of license, hasta la vista, you're not going to be able to get licensed. Your child support has to be current. Any judgments have to be paid in full. Now, medical, they may grant you some leniency. Now, a processor, closer, underwriter, as long as they do their required information, that's fine. But if they do any one of the top 3 on letter A, originator, solicit, negotiate terms or fees, expect compensation, you got to be licensed no matter who. You have to update your MU1 for a company, MU4 for your MLO whenever you have any changes, address, bankruptcy, foreclosure, anything. Now, NMLS number has to be on everything that you are marketing, including your Facebook or LinkedIn profile. All right. Now, by the one last thing, if you or your company are sent a letter from the state, you better respond. If you don't, within 30 days, you could be fined, suspended, cease and desist, but ultimately you don't want is revocation. So it's best to always respond if there's a complaint or violation. All right, is Anthony on?
Yes, I am.
Okay, here's Anthony talking about the great program that MEC is offering for today only.
Well, thanks, Marv, for a wonderful test prep that we've offered for everyone here. We've actually had a couple people in the chat ask, what should I do as far as what should I order? And this is what we came up with. It's a new year. We want you to pass the test. That's one of the things that we want to focus on with our students, because when you pass the test, you'll get your license. We want you to be successful in the mortgage business. So for the next day, what we're going to do is with our ultimate test prep. Our ultimate test prep has 1,500 practice questions, has about 7 hours of topic-specific videos. It also has 8 practice national exams. The national exam is 125 questions, and so this will really help you in practicing to go take that national exam. Also flashcards, topic-specific quizzes, and we have some additional workbook and answers. We normally sell this all day for $150. For the next day, we chopped it in half, 50% off, 75 bucks. And that does include our test reimbursement guarantee. So if you go through the entire material, you have to make sure to go through all the practice questions, view all the videos, and you go and you don't pass the national exam, we'll reimburse that $110 fee that you've paid. So that's just 75 bucks today only, just for being on this webinar. We really appreciate your business. I've noticed I got a couple questions coming in on the chat. I would for sure go ahead and purchase it. Even if you have the test coming up in a couple days, I've shared that with you. So you can give us a call, 877-403-1428. Visit the link that I've shared, and Yeah, there's no discount or coupon code needed. It's already marked down. You can purchase it online, or you can give us a call and we'll be able to set you up with that MEC Ultimate Test Prep.
Okay, what a deal for you people. Ultimately, what a great deal for everybody. That's a great guarantee. So,
We
okay.
stand by our product and we're looking forward to having a lot of students pass the test. So Marv, with that, I'll let you close it out. We again appreciate your business and value you as a student.
Okay, great. Thank you, Anthony. Now, one last thing, transitional license. If you're doing a temporary, if you're at a bank, you want to come over to a mortgage bank or mortgage broker, you can get a 120-day license. You can finish up all of your paperwork and you can originate loans during that time. If you don't have complete all your licensing requirements, of course, then you can't be funded on those loans because you're not licensed. Okay. We've got the program that you've got there. I also offer tutoring, 5 to 7 sessions, 1 hour webinars, one-on-one. We cover a lot of material, all webinars, and we work with your schedule the best we can. Now, we'll be provided how you're doing in your preparation. We'll be doing evaluations. All of this information is again available on the website to sign up for tutoring. Okay, you're going to all get the license, make some money, have a great time, and congratulations to everybody. You can now go home, buy the packages quick. Don't let them get away. And thank you very much. Happy New Year to everybody, and please be safe.